I'm Jeanine Poggiolini. I'm the Technical Director at the Accounting Standards Board, and I'm going to be talking to you today about GRAP 108 on statutory receivables. This standard is newly effective. It's effective for all entities from 1 April 2019, except for trading entities, but for trading entities obviously it's encouraged that you early adopt the standard and at least consider its principles in formulating your accounting policies. So I'm going to give you a fairly high-level overview, starting with what statutory receivables are, having a look at what the accounting problem is that GRAP 108 is trying to solve, what are the key principles of GRAP 108, and you'd appreciate we're going through these at a fairly high level, so you obviously still need to consult the standard and all the material that we have. What are the arrangements for the first-time adoption of the standard? If there are any other changes to any other standards that we have, what those are and what the effect is, and then having a look at what potential implications are for the standard's adoption. So firstly, let's start off with what are statutory receivables. From a definitional perspective, there are receivables that arise from legislation, so laws, supporting regulations, or similar means. And this could be gazettes, it could be cabinet decisions, it could be anything along those kinds of lines that would fall within the realm of what we would typically call secondary legislation. And then more importantly is that these receivables require settlement in cash or another financial instrument. So you'll see this part of the definition, we typically call these kinds of receivables monetary assets because there is some similarity between these kinds of receivables and financial instruments, and we'll talk about that in a minute. Some typical examples of what we would see as being statutory receivables are taxes, so income tax that you would pay, personal income tax, company income tax, UIF, VAT, a whole lot of other kinds of taxes. From a local government perspective, property taxes is obviously a key statutory receivable. Fines, and these are usually fines typically where there's been a breach of a law. It could happen that you have a contractual arrangement where you would have a fine that you need to pay. So typically if you, for example, miss a payment, or particularly if you're renting property, you might have to pay certain kinds of fines and penalties if you have damages and those kinds of things. Any fines that are linked to contractual arrangements are not statutory receivables, but we'll have a discussion about the key distinction between those two in a minute. Importantly, appropriations, grants and transfers in terms of the Division of Revenue Act both nationally and at each province are also very good examples of statutory receivables. And the last one is very broad. It's other charges, which could include fees for licenses, levies and other kinds of amounts that are paid, but as a result of particular pieces of legislation that require entities to charge these amounts. And there's quite a strong link between this and IGRAP 19 on liabilities to pay levies. So now that you have a very sort of clear overview of what are the kinds of things that we are talking about, I think let's understand what is the accounting problem that we are trying to solve with GRAP 108. And I think let's start off with GRAP 104. As I mentioned, there is some similarity between statutory receivables and financial instruments. GRAP 104, to be a financial instrument and more particularly a financial asset, is that it should be a contractual arrangement in place and it would require settlement in cash or another financial instrument. So if we're having a look at contractual arrangements, GRAP 104 in the application guidance sets out some concepts for what a contract should be. And a contract, or at least its key distinguishing features, is firstly is that there must be willing parties, there must be rights and obligations placed on either party in the arrangement, and those rights and obligations would be enforceable. Now you'd appreciate for contractual arrangements, typically there's a clear market for these kinds of assets and liabilities. So there's a fairly high reliance on both the use of fair value and market-related rates. Obviously, if we are having a look at receivables that arise from legislation, obviously they do not meet the first requirement, or at least the first criteria for a contractual arrangement, because generally legislative arrangements, the parties to those arrangements are not willing. So obviously this has quite a big impact on the measurement that we would apply for these kinds of receivables, because clearly if parties are not willing, there isn't an active market. It's very difficult to determine what fair value would be, and it would be very difficult to determine market-related rates, particularly if we are talking about interest. So what you would have seen to date is that there isn't any clear guidance on how to deal with these statutory arrangements because they are not in the scope of GRAP 104 because they don't meet the definition. So because there isn't any guidance, entities would have been typically preparing their own accounting policies either based on GRAP 104 or using the framework or something else. So there has really been a clear lack of guidance, particularly from a measurement perspective, on how to deal with statutory receivables. So let's have a look firstly what are sort of the key principles of GRAP 108, and I start off just at a very high level what the key principles are, and then we'll discuss all of those in detail. I think firstly with the first place to start when we're talking about receivables is when do I recognize them, what's the transaction date, when would I start recording them in my financial statements. And obviously I think it's quite obvious receivables are linked to revenue transactions, so you would need to have a look at the revenue transactions in deciding when actually the receivable would arise. So statutory receivables can be both exchange and non-exchange in nature. You would appreciate that things like licenses and levies could be exchange transactions, whereas if we're looking at things like taxes and fines and appropriations, they would probably be non-exchange transactions. But we need to have a look at both GRAP 23 and GRAP 9 when we start looking at the initial recognition of receivables. At what amount would you recognize these transactions initially? You would look at the transaction amount, which is described in GRAP 108, but it's linked directly to the guidance in GRAP 9 and GRAP 23. At each reporting date, you would then need to have a look at what GRAP 108 says, and it's quite specific about you need to use the cost method. And as I mentioned, because these are statutory arrangements, we are not really looking to use too much fair value guidance. We're not really looking to use too much market inputs into the valuation. Because these transactions are compulsory, it's quite difficult to determine what that would be. So we are prescribing the cost method that you would use at each reporting date, and we'll go through the detail of what that means. And then from a disclosure perspective, we're not going to go through all the disclosures as part of this presentation, but really the key idea is that users should be able to understand the significance of statutory receivables, both in terms of the statement of financial performance from a revenue perspective, but then also having a look at the quantum of receivables from a balance sheet perspective. So if we have a look firstly at initial recognition to give you a little bit of an idea of what you need to look at, as I mentioned, you would need to have a look at the revenue standards as a starting point, and it could be GRAP 9, which deals with exchange revenue, or it could be GRAP 23, which deals with non-exchange revenue. Appreciate that there is often a lot of judgment that you would need to apply to decide whether or not a transaction is exchange or non-exchange. For some it's fairly clear cut, so for example taxes and appropriations, I think it's clear it's GRAP 23, but if we are talking about licenses and other fees, you would need to really assess whether or not there's been an exchange of equal value to decide whether or not you're in GRAP 9 or GRAP 23. But just to give you a very high level overview, obviously when you are recognizing revenue, the point at which you recognize revenue, the contra entry for that is going to be the receivable. So this is really the transaction that generates the recognition of the statutory receivable. From a GRAP 9 point of view, it's either going to be based on whether or not you have sales of goods and services, and obviously if it's sales of goods you would need to have a look at the transfer of risks and rewards primarily. There are other criteria, and if we are having a look at the rendering of services, it's based on the stage of completion, also again with other criteria that you need to have a look at, and then the contra entry would be the receivable that you recognize. From a GRAP 23 point of view, the starting point is slightly different. You need to have a look at whether or not you have a control of a resource based on the specific rights and obligations in place with the arrangement that you have, and if you do, you would then obviously go about either recognizing revenue or a liability depending on if there are conditions associated with it. And obviously the revenue recognition is then either based on the satisfaction of those conditions, or if there are no conditions, you would just recognize revenue upfront. But I think quite importantly in GRAP 23, I think the focus has been on recognizing non-monetary assets, so physical assets that you would receive. So obviously in GRAP 23 at the moment, building in this idea that some receivables that you have are actually monetary assets is obviously changing the focus a little bit, and that's why the guidance is needed, particularly in GRAP 108. So very clearly if there's going to be settlement in cash or something else like a financial instrument, it would be a monetary asset in the scope of GRAP 23. If we have a look at the initial measurement, and I think this is where there has been a little bit of a struggle actually in developing the guidance for GRAP 108, it was quite contentious during its development, is obviously GRAP 9 and GRAP 23 already talk about you recognizing at least revenue based on fair value, and we'll talk about the various ideas about that. But what does fair value mean if we're actually talking about a compulsory transaction that arises from legislation? So GRAP 108 very clearly indicates that the transaction amount is the amount specified, calculated, levied or charged in accordance with legislation or supporting regulations or similar means. So I think it makes it quite clear that the transaction amount is going to be very clearly whatever legislation or the equivalent says it should be. So how that links with GRAP 9, GRAP 9 for example says that you would need to recognize revenue, and obviously the receivable goes with it, at the fair value of the consideration received or receivable. And from a GRAP 23 point of view, it talks about the fair value. All that we're saying is that the fair value for those transactions is very clearly what's in legislation. So if you're trying to understand what the implications are, if you compare this to, for example, contractual arrangements, in GRAP 9 you would have to consider, for example, the effect of discounting and including market-related rates of interest into assessing whether or not you should be splitting between revenue and interest. For GRAP 108, you don't need to do that. You're simply going to recognize whatever the transaction amount is in legislation or equivalent. So it's a simpler approach, and it's really, as I said, stemming from the idea that because there is no market for these transactions, you would really need to base it on legislation, because finding rates and all of these kinds of things for these transactions is quite difficult. I'm going to run just through a couple of examples with you, and I think just to note that they're fairly simple examples, they're illustrative only. You would obviously always need to have a look at the specific facts and circumstances of your transaction to decide how to account for it. So these are really just illustrations of typical examples that we would see and what the effect would be. So the first example I think is something a lot of public entities and others would be familiar with. The example is a public entity that receives a grant outlined in the Division of Revenue Act. The grant is for R1 million. It will be typically settled on a quarterly basis based on the PFMA and the MFMA requirements. What you would do is at the start of the year, obviously this is a GRAP 23 transaction, you would need to assess whether or not you have control of the resource. Typically entities would have control at the start of the financial year because the Division of Revenue Act indicates that the entity would be entitled to that revenue. It would be settled obviously in a quarterly basis, but that doesn't affect the entitlement upfront. So recognize the R1 million, debit the asset of R1 million on the 1st of April, and then credit revenue or liability depending on if there are conditions that need to be satisfied. You will notice that even though there's going to be settlement over a quarterly basis, we're not going to factor that into the accounting, because remember, as I said, fair value is equal to the transaction amount, and the transaction amount in GRAP 108 is very clearly whatever is outlined in legislation or equivalent. So you don't need to worry about the effect of discounting. If we're looking at example 2 that I've given you, it's also a public entity, and this is trying to demonstrate potential accounting for levies. Now I want to say up front, I've made an assumption that this is a non-exchange transaction. As I said, there is a lot of judgment that you sometimes need to apply for these kinds of arrangements, particularly if it's licenses or levies, whether or not you think it's exchange or not. I've assumed for this transaction it's non-exchange because I would sort of see this as in the realm of a tax that entities would need to collect. And the example is it's a public entity. They levy 1% of the value of goods that go across the South African borders. And obviously based on that, I've assumed it's a tax. Assume that for a particular month there have been goods of 50 million that have crossed the border. At the end of April, what we're going to do is debit receivables of 500,000, which would obviously be the 50 million times the 1%, and then credit revenue, which I've assumed is non-exchange. Obviously, you would have different receivables and obviously as the transaction arises, as the goods move over the border, you would need to recognize the receivable, but just kind of for ease of illustration, I've assumed this all happening in 1 month and obviously just one global receivable amount. The third example relates to property rates, and this is typically in the local government sector. Municipalities would have a valuation roll, which indicates what the valuation of properties are. The bylaws would indicate what the percentage is of tax that the municipalities are entitled to collect on properties. So assume that the bylaws outline that the property tax is 5%, the valuation roll is 100 million, you have rebates of 1 million, and then if you are an indigent customer, which typically you are getting further concessions on your property rates, they have decided to waive the tax of 500,000. So in this instance, at the start of the year, the municipality, in terms of the Property Rates Act, is also entitled to the taxes up front. The municipalities allow entities to actually collect the funds over the year. So there is sort of a delayed collection, but the municipality is entitled to the money up front. So on the 1st of July, we're going to debit the receivables. Again, there would be different receivables accounts, and then credit property rates of 3.5 million. Again, I want to stress, if we were having a look at financial instruments and contractual arrangements, you would need to factor in discounting potentially into these kinds of arrangements. But because we are saying the transaction amount in GRAP 108 is whatever is said in legislation or equivalent, we're going to just use that amount, so we don't need to worry about discounting. If we move on to subsequent measurement, and this is also something unique, you won't find it in any of the other standards, and it's really quite different to what we have in financial instruments. So subsequent measurement is what we are going to reflect the receivable at each reporting date, and it's going to be based on the cost method. And the cost method firstly starts off with the transaction amount that you would have recognized, so based on the 3 examples that we've just discussed, plus you would add any accrued interest or any other penalties or levies that you may be entitled to collect in terms of legislation. But I want to stress that you only accrue interest if required to do so in terms of legislation or equivalent. So it's not the case where we have GRAP 104, where obviously if you're not going to charge interest, you're going to have sort of this fair value adjustment up front. We are not doing that. We are really just basing the measurement based on what is in legislation. So you would accrue interest based on whatever legislation requires. You don't need to worry if the interest is market related or not. You don't need to worry about whether or not it's simple or compound interest. You simply do whatever legislation requires you to do. Quite importantly, and we'll talk about this quite a bit in terms of the potential implications, is that interest can be classified as either exchange or non-exchange, depending on what the underlying transaction is. So I think up until this point, you would have always typically classified interest as exchange because it's only ever been mentioned in GRAP 109, in GRAP 9. But obviously, if we are talking about GRAP 108, that can be both exchange and non-exchange, I think it's going to be fairly difficult for entities to always have interest as exchange, particularly if you're having a look at the classification of the receivables that we'll talk about under the disclosure section. So you really would separate interest between whether or not it is exchange or non-exchange based on the underlying transaction. Importantly, sometimes legislation doesn't require you to charge interest, but in lieu of interest to charge fines or penalties or something equivalent. Obviously, if legislation requires you to do that, you would add it to the transaction amount in determining what your subsequent measurement would be. You would adjust for any accumulated losses, impairment losses, or any reversals of those, and we'll talk about that in quite a bit of detail. And then lastly, any amounts that would have been derecognized. So derecognized is when it's either partial or full removal of the receivable from your financial statements. So I think the most common one that you will come across for GRAP 108 is either settlement, so the counterparty has paid, the debt may have expired in terms of law or whatever the specific circumstances are, or the entity would have waived the debt. There are 2 other requirements for derecognition, but I'm not going to go through those in great detail because typically we wouldn't see those kinds of things happening for statutory receivables. So just to give you an indication of how this would work, I'm going to extend the example 2 that was on slide 21, which was really having a look at the public entity with the goods that crossed the border and the fees that they would charge. So the last example was the initial recognition during April, so assume it's May month and we're having a look at all the subsequent penalties, etc. that we need to have a look at. So let's assume that the legislation doesn't require interest, but it does require you to charge a penalty in lieu of interest. Assume that's 20,000. You've received payment of 350,000, and you need to assess obviously if there is impairment. Let's assume for this month there was no impairment, and I'll go through that in a bit of detail now. So the transaction amount would have been the 500,000 levies that we had recognized initially. We have the accrued penalties that we need to charge, which is 20,000. We've said no impairment. And then we've obviously received payment of 350, which gives us a balance of 170,000 at the end of the month. So obviously in terms of accounting for that, you would obviously increase the receivables and the revenue with those amounts, and obviously de-recognize receivables and debit the bank with the amount that has been received. So a key component of the cost method is having a look at impairment. Now, impairment means that either you're not going to collect all of the money, or you're going to receive it in a delayed sort of manner compared to how it would have been settled. So it's both what is going to be received and over what period of time. So the time value of money needs to be considered in these arrangements. So impairment, it is fairly similar to the current requirements in GRAP 104. You'll see a lot of similarities between at least the mechanism of how we do the impairment. If there are going to be revisions to GRAP 104 that the board would potentially approve, the impairment loss model is going to change slightly, but it could still be a period of time for that. So we still have an incurred loss model at the moment in GRAP 108 and also in GRAP 104. That says that we need to assess at each reporting date if there is an indication that there's been an impairment. So what this means is that an event would have happened. You would need to assess what that event is and decide whether or not it affects the collectability of the receivables that you have recognized. So some examples are significant financial difficulty of the debtor, or for example, they've entered into debt rescue. The debtor could enter into sequestration, liquidation, business rescue, whatever it could be. There's a breach in the terms of the transaction, and typically this would be that there's been default, so somebody needs to pay you 30 days, let's say, after you've issued them a statement, but they haven't paid. That would be default. There have been adverse changes in the economic conditions, so for example, it could be that there's a high rate of unemployment, it could be that particular businesses are shutting down within a municipal space, or whatever the case might be, that could affect the collectability of certain charges that you've raised. And then obviously you would need to consider if there's anything else that you would need to think about in terms of specific events that would drive impairment. So that's having a look at when there could be an indication of impairment. The next one is how would you actually go about calculating impairment? So I think the first thing is there should be an assessment of, are there individually significant debtors that I would need to have a look at and decide to impair those individually. But then I also need to group individually insignificant debtors together and obviously work out what I think potential impairment is going to be for those. And obviously importantly, you would need to do this grouping based on debtors that have similar risk characteristics, either credit risk characteristics or geography, or in terms of the transaction type. But there is a bit of guidance in GRAP 108 for you to have a look at. So you would calculate the impairment loss based on the difference between the estimated future cash flows, which would obviously include how much you're going to get and when you think you're going to get it, compared to the carrying amount, and the difference would be an impairment loss that you would recognize. And I think importantly, in working out the future cash flows, as I said, it's both the amount and the timing. So if you're going to receive delayed payment, you would need to consider the time value of money. And obviously we're back now to considering what interest rate you should use. You should use a risk-free rate for a similar debt instrument. So again, we're not doing what we would do in financial instruments and look to a market rate or the effective interest rate on recognition. You're really just going to have a look at what the risk-free rate would be at that point in time. So now that we know what amount of impairment we're going to recognize, I think we need to have a look at how you would actually go about accounting for the impairment. And firstly, if you've had an individually significant debtor, you would reduce that debtor's balance on its own. Or if you've used groups of debtors, you would just use an allowance account and adjust that. But importantly, the impairment loss is obviously going to be an expense in surplus or deficit, or if it's going to be an adjustment if there's going to be a reversal in subsequent reporting periods. Quite importantly, you would need to have a look at each period apart from whether or not there's been an indication of impairment. You would need to have a look whether or not there's any reversal or adjustment that you would need to account for. And this could be changes in the actual cash flows that you think you're going to collect, or the period over which you're going to collect them, or perhaps the entity's circumstances has changed and you have a complete reversal. If you do have a reversal though, you can't increase the receivable balance above what the carrying amount would have been at that point in time. So if we have a look at example 2, just to extend it again, included in the fact pattern some more information about specific debtors. So assume in June there's one specific debtor that has entered into business rescue. They've indicated that they'll be able to pay you 85,000 Rand within a year's time, and obviously that would include both the amount that you think you're not going to get plus the time period. So having a look at individually significant debtors first, that's the one that you've identified. Then having a look at the rest of the debtors, sort of based on loss experience, you would expect the remaining debtors to, if the debt is older than 60 days, to only receive 50% of the debt. Because of the delayed payment, still charging penalties, so assume another 7,000 that we're going to add, and that there's no further cash that you have received in settlement. So the transaction amount carried over from the previous month is 170,000. We would accrue interest and other charges of 7. We're going to deduct an impairment loss of 50,000, which is going to be the 15,000 for debtor, for the individually significant debtor, which is 100,000 less 85 that we think we're going to collect. And the rest is going to be the 170 debtors balance that we have left. Let's take out the individually significant one that you've already calculated, and we have a 50% loss rate, so that gives us 35,000. And that gives us the balance at the end of the month. In terms of the example, I'm not going to go through all the debits and credits. I think the only thing that's just to be mindful of on the next 2 slides is obviously for recognizing the impairment loss for debtor B, there's going to be a clear reduction of the debtor's balance. So 15,000 is going to be reduced for that one. And then obviously the remaining debtors, where you sort of group them together, is going to be a 35,000 loss that you recognize in the loss account. Okay, so we've dealt with recognition, we've dealt with measurement. Let's have a look at presentation and disclosure of information in the financial statements. So firstly, as I mentioned up front, the purpose of the disclosures is to give users of the financial statements an idea of the significance of statutory receivables, both to the income statement and to the balance sheet. So you would obviously need to provide them with sufficient information to achieve that objective, but also provide them with sufficient information in the notes to be able to reconcile all sort of the key numbers that you have on both the income statement and the balance sheet to the more detailed information that you have in the notes. Importantly, over and above GRAP 108, you would obviously need to apply GRAP 9, GRAP 23 and GRAP 1 primarily, and any other standard that deals with receivable related information. So I'm not going to run through all of the disclosures with you, but just want to touch on a couple. So the first one, and I think this is the most important disclosure, is you obviously need to provide quite a detailed description of the types of statutory receivables you have linked to the revenue transaction. Now, bearing in mind, as I mentioned, these are really driven by whatever is required in legislation. You're going to have to provide quite a lot of detailed information to users of the financial statements about the legal requirements and obviously how you've gone about applying those from an accounting perspective. So you would need to describe information about how the transaction arises, what particular legislation. Obviously, it stems from how you've gone about determining the transaction amount, whether or not there is interest and penalties charged and on what basis, how you've gone about assessing impairment, whether it's individually or grouped together, and if it's grouped together, what sort of characteristics have you used, and then what discount rate you would have applied, because remember, if the time value of money is going to become material, you would need to have a look at using a risk-free rate, and then importantly, what you've used. You would importantly need to disclose the carrying amount of statutory receivables separately in the notes to the financial statements from other receivables. So what this means is that you would need to have 2 lines, one dealing with receivables arising from contractual arrangements, so financial asset receivables, and statutory receivables separately. And then there could be other kinds of receivables like prepayments and things like that that are not really dealt with in either of those 2 standards, but there's going to be greater analysis of the receivable line item than what there is at the moment. So what are the arrangements for adopting the standard for the first time? So GRAP 108 you need to apply retrospectively. So this means you would need to have a look at what your current receivables are and obviously go back and adjust the recognition and measurement of those, both for the current period and the prior periods, except in 2 areas. The first one is derecognition and the second is impairment. So derecognition, you only apply the requirements for derecognition to the receivables you have at the moment, so going forward. And if you have de-recognized receivables in the past, you don't need to go and assess whether or not you should have de-recognized them or not. You can just leave them as they are. So you really just have a look at the current receivables and apply the requirements on a go-forward basis. The other one is impairment. Obviously, impairment is an at-a-date assessment, so you can't apply impairment generally retrospectively. So you would need to, again, have a look at your receivables balances at specific dates and just go forward. We have outlined a transitional relief period for statutory receivables, and entities have 3 years within which to change their classification and measurement for statutory receivables. So you will see it doesn't relate to recognition, because we would assume that entities have been recognizing statutory receivables already. Probably the measurement could be different and they might not be classified as statutory receivables. So you have 3 years to get the classification right, and remember, as I said, there's going to be greater analysis of the receivables balances in the notes, so it gives you time to do that, but it also gives you time to implement particularly the cost method that we have prescribed for the subsequent measurement. Okay, so let's talk about some changes to other standards, and we have touched a little bit on these, and I think the most important one for you to be aware of is the classification of interest. As I said, probably up until now, interest would have always been classified as an exchange transaction, because GRAP 9 is the only place that talks about interest recognition. But as I've mentioned, because statutory receivables can be both exchange and non-exchange in nature, the interest would really follow whatever the underlying transaction is. So it is possible for you to have interest revenue that's going to be classified as non-exchange revenue. And this is important because you need to make this distinction in the statement of financial performance and the notes. So I think that's a very important change that you need to be aware of, and obviously you would need to have systems to deal with that. So what are the potential implications for the first-time adoption? As I mentioned, entities would have applied their own policies in the past because there just hasn't been very clear guidance about what to do with statutory receivables. So I can't give you a precise indication of what entities definitely would have been doing and what they would be required to do now. I think most entities have been using GRAP 104 or a variation thereof to account for statutory receivables. So I'm going to try and give you an indication of, if you did apply a GRAP 104 sort of policy, what the potential implications are. And just to give you an idea, probably the key differences between GRAP 108 and 104, on the initial recognition, I doubt there would be a lot of variation, just because entities would have been using GRAP 9 and GRAP 23 in either instance anyway. But I think where there could be some difference is on the initial measurement. Obviously, GRAP 104 does require you to recognize at fair value and using market-related rates of interest, which obviously typically you wouldn't find in statutory arrangements. So that idea of having to look for a market rate, obviously you wouldn't find in GRAP 108, so potentially some variation there. I think the other space is for transaction costs. So obviously GRAP 108 is not as explicit about how to treat transaction costs as GRAP 104. And obviously for subsequent measurement, obviously GRAP 104, you would either use fair value or amortized cost depending on the facts and circumstances of the transaction. Typically, I think these would be in the amortized cost kind of space. But obviously from GRAP 108 we are using a cost method, which obviously we've been through, and there really is a very low reliance on any kind of market factors, because you are just going to use risk-free rates, whereas even if you're on GRAP 104 and you're using amortized cost, it would have been a market-related rate at a point in time that you would have needed to consider. So that would typically be the difference if you have used a GRAP 104 accounting policy. So as I mentioned, we don't really know, because entities would have developed an accounting policy based on whatever they thought was appropriate. It is a little bit imprecise in terms of what entities could have used. Some other implications to think about is, as I mentioned, there is a separate disclosure of statutory receivables in the notes to the financial statements, which wasn't there before, so you're going to have to develop systems to deal with that. The classification of interest, which has changed between both now exchange and non-exchange. And as I said, this really implies the need for very clear policies on how you're going to account for transactions, whether they exchange, non-exchange, and how you're going to go about recognizing both the receivable and the interest. And you would need to have appropriate systems to identify the various transactions, and then obviously understand how you're going to classify them and how you're going to record them.